Welcome everyone to Unit 2 of the AAA module. I'm Lisa, one of your AAA module leaders. This is a short video to give you an overview of what's covered in Unit 2. Unit 2 covers the following key topics: the importance of audit quality, fundamental ethical principles, auditor independence, and pre-engagement activities. Let's now summarise each of these topics. Given the severe consequences of audit failure, promoting audit quality is in the interest of everyone, from participants in financial markets, large and small, through to auditors and regulators. Audit quality is important so that users can have continued confidence. What do we mean by that? Remember in Unit 1 we discussed the purpose of an audit, which is to increase the confidence of users in the financial statements by having an independent party check them. Therefore, maintaining and improving audit quality is essential to the continued confidence in the independent assurance provided by auditors. Audit quality is maintained by enforcing this, whereby the auditor is audited. Audit firms are subject to oversight by the regulators responsible for enforcing audit quality. As high-quality audits are integral to the proper functioning of the financial markets, the same regulatory body that oversees the financial markets is also typically responsible for regulating auditors. For example, the Australian Securities and Investment Commission, ASIC, regulates the corporate market and financial services in Australia. So auditors in Australia are subject to oversight by ASIC. The Financial Markets Authority in New Zealand, FMA-NZ, is the body regulating capital markets and financial services in New Zealand. So auditors in New Zealand are subject to oversight by FMA-NZ. ASIC and FMA-NZ monitor audit quality by conducting periodic audit inspections of a sample of completed audit engagements during a given inspection cycle, which is typically a period of 12 to 18 months. Standard-setting bodies have made it clear that first and foremost, professional judgment and professional skepticism are the principles on which audit quality is built. It is impossible to create rules that anticipate and function effectively in all circumstances in today's increasingly complex business environment. This is why the principles-based approach of the framework and the auditing standards establishes a baseline for audit quality and is not intended to be prescriptive or exhaustive. So the auditors must always think about the specific facts and circumstances of each situation and use their professional judgment in applying the framework and the standards while maintaining their professional skepticism. In addition to this principle-based approach, there are several standards that set out specific guidelines designed to promote audit quality. ISQC1 sets out audit quality guidelines at a firm level, and ISO 220 sets out audit quality guidelines at an individual engagement level. With respect to audit quality at the firm level, the following diagram summarises the various elements of a system of quality control required at a firm level, leadership responsibilities for quality within the firm, as audit quality starts at the top. Relevant ethical requirements such as compliance with independence requirements. The need to determine acceptance and continuance of client relationships and specific engagements. Human resources and the need to employ competent staff and ongoing training. Engagement performance, including the need for review of work by more experienced staff. Monitoring that quality control policies and procedures are operating effectively. Documentation of its policies and procedures regarding each of these elements of quality control and communicating them to staff. Read ISQC1 for audit quality requirements at a firm level. With respect to audit quality at the individual engagement level, ISO 220 sets out guidelines for engagement teams to follow. ISO 220 is written with the presumption that the audit firm has properly implemented the principles set out in ISQC1. So, for example, where ISQC1 requires the audit firm to establish a monitoring process, ISO 220 requires the engagement partner to consider the results from the firm's monitoring process and their relevance to a particular audit engagement. Most firms will have developed their own audit and policies manuals, which will contain requirements that are based on international auditing standards. Read ISO 220 for audit quality requirements at an individual engagement level. The International Code of Ethics for Professional Accountants, the IESBA Code, which we will refer to as the Code for the remainder of this video, sets out the ethics requirements for professional accountants. The Code is structured into 4 parts. While all the sections of the Code are equally important, this unit focuses on parts 1, 3, 4A and 4B. The Code lists the 5 fundamental principles that professional accountants must adhere to as integrity, which means to be honest in all professional relationships; objectivity, which refers to not allowing bias or a conflict of interest to override professional judgments; professional competence and due care, which is to maintain professional knowledge and skills at the level required to ensure that a client or employer receives competent professional services; confidentiality, this is self-explanatory, not disclosing any information acquired from a professional or business relationship to third parties without proper and specific authority; and professional behaviour. Simply put, it's practicing all of the principles we've just outlined so that your conduct would not discredit the profession. Each of these 5 principles are discussed in more detail in sections 110 to 115 of the Code. As we just discussed, one of the fundamental ethical principles is objectivity. The concept of independence is fundamental to compliance with the principles of objectivity and integrity. Part 4 of the Code therefore contains the independence standards. Part 4A is relevant to audit and review engagements only. Part 4B is relevant to any other assurance engagement. With respect to assurance engagement, the Code emphasises that when providing an assurance service, the assurance practitioner must be independent of the client. This is further defined as independence of mind, which is actual independence, and independence in appearance, which is perceived independence as viewed by an outside party. This is necessary to enable the assurance practitioner to express a conclusion without bias, conflict of interest, or undue influence of others, which is imperative based on our understanding of the purpose of an audit. The audit of an entity is relevant to a wide range of potential users, and so the actual and perceived independence of the audit is of particular significance. These concepts are covered in Section 400 of the Code for audit and review engagements and Section 900 for other assurance engagements. The following parties are required to be independent of the audit client: members of the audit team, the audit firm, and any network firms. The Code includes a conceptual framework to assist accountants in complying with the fundamental principles and independence requirements. The conceptual framework specifies a 3-step approach to ethical issues that arise. 1. Identify threats to independence. 2. Evaluate the significance of the threats identified. 3. Address the threats by eliminating or reducing them to an acceptable level. Compliance with the fundamental principles and independence may potentially be threatened by a broad range of circumstances and relationships. The nature and significance of the threats will differ depending on many factors. For example, is the service for an audit client that is a public listed entity? The threats fall into one or more of the following categories. Self-interest threat. This may arise when, for example, the audit partner owns shares in the audit client. As the audit partner has a financial interest which they wish to benefit from by the client achieving a higher profit, their professional judgment may be compromised during the audit. Self-review threat. This may arise when the auditor is auditing financial statements which have been prepared by another staff member in a different division of the audit firm. The auditor may just rely on this work rather than appropriately evaluating it. Advocacy threat. This may arise if the auditor promotes the purchase of shares in a listed audit client, which could result in objectivity being compromised. Familiarity threat. This is self-explanatory. Long periods or close working relationships with a client may compromise professional judgment and professional skepticism. For example, the partner states that from their previous working relationship with the CFO, everything is always done accurately. This may result in the client's work not being appropriately evaluated. And finally, intimidation threat. Simply put, the audit client threatens the auditor by saying, "If you don't provide an unmodified opinion, I will take the audit work to another firm next year." Note that parts 3, 4A and 4B of the code do not describe all the circumstances and relationships that create or may create threats to compliance with the fundamental principles and independence. Professional accountants in public practice are encouraged to be alert for such circumstances or relationships. Remember, if threats are identified, then the assurance practitioner needs to evaluate the significance of the threats identified and address the threats by eliminating the circumstance or relationship that created the threat, applying safeguards where available and capable of being applied to reduce the threat to an acceptable level, or declining or ending the audit engagement. Remember, it's always important to document the procedures performed and how threats and issues were resolved. Refer to the code parts 4A and 4B for assurance engagements, which describe the specific circumstances and relationships that create or may create threats to independence, factors that are relevant in evaluating the level of the threat, types of safeguards that may be appropriate to eliminate or reduce the threat, and circumstances in which no safeguards could reduce the threats to an acceptable level. What we have gone through in this overview video are activities that the auditor must perform before accepting, continuing, and commencing an audit engagement. These activities are collectively known as the pre-engagement activities. So, in summary, the major activities in the pre-engagement process are as follows. Does the firm have the resources, time, and competence to perform the work, which we discussed in the importance of audit quality? Is the firm independent and free from conflict, and are the risks involved acceptable, as we discussed in auditor independence? A decision is then made to accept or continue with the client. Note that before agreeing to undertake an audit, the auditor is also required to ensure that the preconditions for the audit are in place. This requires the auditor to determine whether the financial reporting framework to be applied in the preparation of the financial statements is acceptable. Obtain agreement from management that it acknowledges and understands what it is responsible for example, the preparation of the financial statements in accordance with the applicable financial reporting framework. If the preconditions for an audit are not present, the auditor must not accept the engagement. The auditor will also determine whether there are any limitations in the scope of the engagement that need to be considered before commencing, and then agreeing on the terms of the engagement, i.e., what is to be done, by whom, and when with the client. This is done by sending the client an engagement letter. Refer to ISO 210, which deals with the auditor's responsibilities in agreeing the terms of the engagement with the client. It is also important for the auditor to develop a constructive working relationship with the audit client by having effective two-way communication with management and those charged with governance. As part of the pre-engagement activities, the auditor is required to determine who within an entity's governance structure is the most appropriate person or persons to communicate with. Those charged with governance are the people within the organisation who are responsible for the strategic direction of the entity and have obligations relating to the accountability of the entity, which includes overseeing the financial reporting process. Usually, those charged with governance include the board of directors. Larger entities typically have an audit committee, which is a subcommittee of the main board of directors. When the auditor communicates with the audit committee, they would determine whether there is also a need to communicate with the main board. ISO 260 details issues that should be communicated by the auditor to those charged with governance. At the planning stage of the audit, this would include communicating the auditor's responsibilities, the fact that the audit of the financial statements does not relieve management or those charged with governance of their responsibilities, and the planned scope and timing of the audit, such as the auditor's approach to internal controls. So that sums up our overview of Unit 2. If you have any further questions regarding Unit 2, please post them on the discussion board. Thank you for watching this video. Look out for other overview videos for the other units in the AAA module. We wish you all very best in your studies.